So we've all seen it, right? That one big headline number for the price of oil. It flashes on the news, goes up, goes down, and it's supposed to tell us everything we need to know about what's going on in the world. But here's the thing, that one number, it's just the cover of a much, much bigger book. It's really just the very beginning of the story, not the whole thing. To really get what's happening under the surface, you've got to look past that single price. You have to learn the language that the market is actually speaking. And that's exactly what we're going to do. We're going to give you the toolkit, the 4 key signals that let you decode the real health of the oil market. All right, let's dive in. Okay, our first and maybe most fundamental signal is all about one simple thing: location, location, location. An oil barrel's value starts with where it is in the world, because the planet isn't just one giant bathtub full of oil that magically keeps itself level. Nope. The world is actually a network of different regions. You've got some places that have way more oil than they can use, so they have to sell it. And then you have other places that don't have nearly enough, so they desperately need to buy it. This constant dance of supply and demand is what creates the physical flow of oil around the globe, and it underpins everything else. And this is where it gets really interesting. Each region has a kind of personality, a role it plays. The Atlantic Basin, for instance, is like the system's shock absorber. Asia is the huge buyer and always needs more. And Europe is this complex hub in the middle. Think about it. A hurricane slams the US Gulf Coast. Suddenly, the Atlantic Basin has to jump into action, rerouting barrels to make sure Asia and Europe still get what they need. It's this incredibly dynamic, interconnected web. Okay, so we've nailed down where the oil is, but the next signal is all about what kind of oil it is. And trust me on this, not all crude oil is created equal. Not even close. This difference in quality gets priced into the market through something called quality differentials. You've basically got 2 main players. On one side, you have your light, sweet crude. It's the good stuff. Low in sulfur, less dense, and much easier to turn into valuable products, like gasoline and diesel. Then you have heavy, sour crude. It's thick, full of nasty sulfur, and you need a really sophisticated, expensive refinery to do anything useful with it. And here is the absolute key. That price gap, the differential between the good stuff and the not so good stuff, it's always moving. It's a direct signal about the health of the world's refineries. If all those complex refineries that handle the tough crudes are running smoothly, the price difference might be small. But what if they start having problems? Well, that discount for the lower quality oil gets way, way bigger. So if you see the price for heavy crude suddenly nosedives compared to light crude, that is a huge red flag that something is wrong with the world's most important refineries. Now, this leads us perfectly into our third signal, which is all about the money. It's about profitability. See, a barrel of crude oil is only valuable because of the products you can make from it. And the way the market tracks this is with something called the crack spread. I know, it's a weird name, but it's an incredibly powerful concept that tells us, very simply, if refineries are making money. It's actually super simple when you break it down. You just take the total price of all the refined products you get, like your gasoline, your diesel, all of that, and then you subtract the cost of the crude oil you started with. That difference, that's the refiner's margin. And this simple math is the signal. A positive, growing crack spread is the market practically screaming at refiners, hey, it's super profitable to make more fuel. Get to it. This is a massive incentive that directly pulls more crude oil into the system. All right, time for our final signal. Now, this one's a little more abstract, but honestly, it might be the most important one of all. It's called the time spread, and it answers one single critical question. Does the market need oil right now, or can it afford to wait? The market really has 2 basic moods when it comes to time. Think of it like buying concert tickets. If the show is tonight and it's totally sold out, those last-minute tickets are going to be insanely expensive, way more than for the same show next month. That's backwardation. It's a signal of scarcity. The market is desperate for the product now and will pay a huge premium for it. But what if the concert isn't selling well? You could probably get tickets for tonight cheap while the promoter tries to sell next month's tickets for more. That's contango. It's a signal of a glut, an abundance. It literally pays you to just store the oil and sell it later. So when you look at these charts, you're literally seeing the market's heartbeat in real time. When you see that steep backwardation, that now price towering over the future price, you can almost feel the panic as traders scramble to find barrels for today. In contango, though, you can picture the opposite, a calm market, tankers just sitting on the water waiting for a better price. It is the single clearest indicator of whether the physical market is stressed out or totally relaxed. So, you see, These four signals, location, quality, transformation, and time, they aren't just separate data points. They all work together, like a complete dashboard that gives you a rich, multi-dimensional picture of what's really going on. By just asking these four questions, you can cut right through all of the noise. You can see the reality of supply and demand, the bottlenecks in the refining system, the actual profitability of making fuel, and the market's real sense of urgency. That's the story that one single headline price can never, ever tell you. So the next time you see that headline number flash across your screen, you'll know there's more to it. You'll know to ask the right questions. Because the price is just a number. The real story is in the signals.